Welcome back to ARCHIP News. Today, we want to address how the current tariff policies could potentially benefit crypto assets in fundamental ways. Let's dive right in. What Trump started on Liberation Day on April 2nd seems to be morphing ever more into a trade and capital war between the world's two largest nations. Naturally, the big question is, what does it mean for crypto? From a fundamental point of view, the outlook could be quite positive. To understand why, it helps to look back to 2019, when tensions between the US and China also escalated during the last major trade war. Back then, the Chinese took action by devaluing their currency against the US dollar. In fact, in August 2019, the yuan dropped below 7 to the dollar, something that hadn't happened since the great financial crisis in 2008. Much like the rhetoric we're hearing today, the US quickly accused China of currency manipulation. This reignited fears of capital flight within China. At the same time, from early May to early August, Bitcoin nearly doubled in price. Many analysts and traders linked part of the rally to Chinese demand as investors looked for ways to move money out of the country. Trading volumes on China-friendly exchanges surged in response. Should the current trade war escalate into another round of extensive yuan devaluation, Bitcoin could catch a bid in China as the preferred vehicle for capital protection. Bitcoin as a successor to the S&P 500 as a global savings vehicle. What is happening currently could even have bigger repercussions down the line, repercussions an asset like Bitcoin could profit from. This is because of global capital shifts that have been accelerated by President Trump's tariff policies. Let me explain. The top priority of the US administration appears to be the recalibration of global trade, with a strong focus on significantly reducing the US trade deficit. However, because the trade deficit is the mirror image of the capital account surplus, a smaller trade deficit would naturally correspond to a decline in capital inflows. All else being equal, a shrinking trade deficit means Americans would buy fewer goods from other countries abroad. As a result, less foreign money would flow back into the US financial markets. If this shift were to happen on a significant scale, there's a real chance that the US stock market may have already peaked in real terms, and that the US financial markets may gradually lose their status as the world's dominant savings and investment hub. In such a scenario, we could see a dynamic similar to Japan's experience, where the stock market peaked in the late 1980s and then entered a long-term decline that lasted for decades. In that case, as global investors would be seeking alternatives, attention would naturally shift to other stores of value. Alongside gold, Bitcoin could emerge as a serious contender, a neutral, borderless investment asset with strong upside potential and growing acceptance in a multipolar financial world. So what is your take? What are the chances of something like this happening? Let us know in the comments. Well, that's it for this week. Don't forget to like, subscribe, and follow ARCHIP for more weekly insights into the future of crypto.